welcoming you to this webinar today. We have a number of people on the call, around 20 from around the world so far. We've got a few more that we expect to continue to join as the call starts. This webinar is going to look at bonds and climate change, State of the Market 2015, essentially a review of the report we've just published, which you can find on our website in PDF download format and a couple of formats. Joining me today will be Tess Olsen-Wrong, market analyst. Our aim is to make this 45 minutes plus questions. I'm going to ask Tess Olsen-Wrong first to do some housekeeping. Tess.
Thanks, Sean. Hi, everyone. Just to let you know that your audio is muted. If you'd like to ask a question during the presentation, please raise your hand using the hand icon at the bottom of the attendees list, and the host will unmute you. You can also use the Q&A box on the right hand of your screen. If you're experiencing any technical problems during the webinar, please contact the panelists using the chat box. Thank you.
Thanks, Tess. I'm going to do a few words of introduction, context. Then we'll plow into some of the detail of the report. And then we'll tackle questions. Of course, if you have questions as we go through, please do type them in. And we will attempt to address as we go, rather than save them all up necessarily towards the end. Thanks again so much for joining us today. Each year we do this report. The goal of the report is to identify for institutional investors in particular, but for all investors interested, the climate-themed or climate-related bonds we find in the world available for investment. This year we find some $597 billion of climate-themed bonds. These are bonds where we see the proceeds going to assets or projects important to a rapid transition to a low-carbon and climate-resilient economy, something we need to do by 2050, something that we need to start on or shift into very quickly if we're to address the challenges of climate change. The Climate Bonds Initiative is an NGO focused on mobilizing debt capital markets, a non-government organization. Our goal is that capital shifts to support that rapid change. We'll also be covering in this report the curious phenomena of the rapid growth of labelled green bonds. By labelled, we mean underwriter and issuer labelling of the bond to make it easier for investors to find them, essentially. It's an important discovery tool. But first, the context for this webinar, for the discussion we're having today, is the nature of global investor interest in climate-related investments. At the United Nations Climate Change Summit in September of last year, we had investors representing some $43 trillion of assets under management signing statements before the Secretary General and the assembled world leaders saying that climate change was an incredibly important challenge facing the planet. The governments needed to act urgently for society and to avoid the dangers to their own portfolios and therefore their ability to pay our pensions, our insurance policies over time. And they stood ready to invest, subject to risk and yield requirements that they need to be able to pay our pensions. That was a very substantial statement globally. That 43 trillion should be compared against US GDP of about 17 trillion. The bulk, half of institutional investors are acutely aware of the macro risks of climate change. They're aware of what the International Energy Agency says is the current path the world economy and the world is heading towards of 6 to 7 degrees warming on average across the planet, which means somewhere between 8 and 11 degrees warming over the continents, because the water won't warm as much and soaks up more heat with the oceans. That is, in the word of incoming CEO of the International Energy Agency, Fatih Birol, a catastrophic future. It's a future of desertification, of weather volatility, of sea level rises of 2 meters during the second half of this year. Some people, such as NASA climate scientists, Jim Hansen, has postulated that he thinks now we'll see 3 to 4 meter sea level rises based on what he reads is happening at the moment. Substantial impact on food crops, especially with volatility. A couple of years ago, we saw the wheat crop in Russia fail. Russia banned all exports. Egypt, that had been buying wheat on the spot market largely from Russia, suddenly had a food crisis. A revolution followed soon after. And some people argue that a similar impact happened in Syria and led to a series of events that led to a war. When we have frequent and major outages of our ability to grow food around the world, which is what we can expect with the climate volatility we're seeing, we will see a lot more economic and social disruption. When we see 6 or 7 degrees warming, we will see a world of failed states, of millions trying to cross the Mediterranean into Europe, not just thousands, of storm surge damage to all the world's coastal cities. Think Hurricane Sandy on steroids. And we will see the growth of epidemics and diseases. That's what happens when we get a stressed planet. And we will lose a lot of people through that process. I'm being not here extreme in my postulations, but of course it's a risk, it's not a certainty. Nothing's a certainty. We could get hit by an asteroid tomorrow. But climate scientists say this is a future with at least a 50% probability. None of us would get into a plane if we felt we had a 50% probability of crashing. This is a story which is rapidly unfolding. In science, you may have come across the term tipping points. In the Arctic, we have a situation where a lot of greenhouse gases, clathrate, methane from old rainforest is frozen under the Arctic ice shelf. Last year, I had the privilege of going to Svalbard, northernmost inhabited spot on the planet, a territory the size of West Virginia. And I saw a beluga whale in the fjord. It's not supposed to be there because the fjord is supposed to be frozen. In the last 10 years, it has been unfrozen all the time. Last year, we saw a Danish research vessel come back from the Arctic ice shelf doing a survey above Siberia, and they reported seeing 1 kilometre wide plumes of methane bubbling up from under the sea. That is frozen methane that has started to unfreeze and leak, the beginning of an adrenaline shot of greenhouse gases into the world's atmosphere. That's a tipping point. As the ice begins to disappear in summer, and make no mistake, it's the thinness of the ice we're more worried about than the breadth at this stage. Icebreakers can now get to the North Pole relatively easily without having to smash their way through ice in the middle of summer because the cap has become so thin. When it goes, we will see an acceleration of warming in the summer Arctic as blue obviously absorbs heat better than white, which reflects the sun. And that will lead to further release of clathrates. Last summer, we actually saw sinkholes open up in the northern Siberian tundra for the first time, as big as one of those sinkholes in Florida that swallow whole houses. After some speculation, it turns out these are effectively exploding methane bubbles from the permafrost melting and the release of methane gas. we have a problem on our hands. In the UN Climate Conference, the international commitments being tabled at the moment for the Paris Conference, according to the climate scientists we've consulted, at best, if they were all delivered, would achieve a world of 3.5 degrees warming. And I can't find anyone in a country around the world who believes they will be all delivered. John Schellenhuber, who's the German government's advisor, the chair of the German government's advisory committee on climate change, is on record as saying the difference between 2 degrees warming and 4 degrees warming is civilization. Unsurprisingly, we're seeing an epidemic of mental health issues, of depression amongst climate scientists. There's now medical literature on the matter to research. We have climate scientists that have been telling us for 20 years, in some cases 30 years, about this future I'm describing, about the extent to which emissions have not gone down but have gone up on average each year for the past 20 years. And yet the world is failing to act adequately in the face of this danger. No wonder there's an epidemic of depression. There is good news in the sense there are still things we can do to avoid the calamity we are heading into, like a freight train on a fast lane. If you speak to the International Energy Agency, if you look at their World Energy Outlook, this is the body, by the way, that coordinates the world's petroleum reserves, not knowing for its alarmist thinking, you will see that the opportunity to stop extreme warming, to keep warming to a relatively modest level, 2 to 2.5 degrees, 3 degrees, that sort of order, is still there if we make substantial investments in a transition to a low carbon and climate resilient economy. In fact, most of the investments they talk about, and they say it's going to involve an investment of about $53 trillion above business as usual between now and 2050. Most of the investments are in energy, mobility, low carbon transport, water, buildings, and a bunch of things that can be characterized as green infrastructure, if you'll allow me to call the built environment in our cities part of that. In fact, it's worth noting that cities are responsible for roughly 82% of emissions globally, energy emissions, I should say. And with the growing urbanization of the planet, decisions about the relative greenness of cities are absolutely critical to addressing mitigation pressures, let alone adaptation pressures that we're going to face. When we think about infrastructure, essentially a green infrastructure revolution we need to have, that's good news because, in fact, we know how to finance infrastructure. We've been doing it for 100 years with freeways, with hospitals, with bridges. We know how to design schemes to attract private capital using, for example, floor price guarantees for tollway revenues or 30-year lease contracts for hospitals in British Columbia or various other mechanisms, guarantees, regulatory support. All of these things have been used very successfully to build the infrastructure that exists in the rich world and to build the infrastructure in China, in Korea, and what we're beginning to see in India. It is a huge capital expenditure lump that we have to get over. This path of going green is a much higher capital expenditure path than the path of staying brown or growing brown, if I can use that colour for fossil fuel-based economy. We make savings. The International Energy Agency estimates that we'll in fact make $100 trillion of savings on fossil fuel inputs for the economies that shift to green. Of course, allocating those to individual investments is a bit of a problem, so we still have to do some work to make this green infrastructure revolution work. Of course, high capital expenditure generally means lower running costs. Let's compare a solar farm with a coal-fired power plant. Half the capital expenditure in a coal-fired power plant, longer running costs, ups and downs, volatility potentially in price. Whereas a solar farm, all the money's up front, then it sits in the desert and earns money. That's a metaphor for the revolution we have to have globally. The second bit of good news, given we have to look at a high capital expenditure transition, is that we have the capital. In fact, the world is currently awash in capital. We have such a dearth of investment opportunities in Europe for that capital that people are paying the German government negative interest rates to take their money. We need to mobilize investments to allow our pension funds and our insurance funds the opportunity to invest now so that they can pay back or pay our pensions and our policies in due course. $88 trillion is the size of the institutional investment sector. That particular sector is made up of insurance funds, pension funds, sovereign wealth funds, fund managers and the like. The socially responsible investment sector, which has been driving this green bonds story, is made up of roughly $13 trillion globally, largely in North America and the US. For this sector, the long-term risks are palpable around climate change, but their portfolio managements are typically 3 to 5 years. For them, the advantage of getting an investment that addresses their short-term risk and yield requirements, whilst as a bonus feature addressing climate change, would be enormous. That's what the green bonds market is. Of course, creating green bonds is not the only solution or even the solution to this climate change challenge. There are other things on the financial side that we need to do. The first thing we need to do is to rebias our economies. The OECD tells us each year that we still have a 10-to-1 ratio of fossil fuel subsidies to green energy subsidies. That's not just Iran and Saudi, that is Germany, the UK, and the US, which still has oil and tax industry credits to introduced in the early part of last century, unchanged, supporting the profitability of Exxon, Chevron, and the likes. This is something that must change. In our financial regulation, we need to rebias towards the kind of investments that are required. Basel III, governing our banks, actively discriminates against long-term debt in favour of short-term liquidity in terms of the capital ratio requirements of banks and Solvency II of insurance funds. This is actually not a good outcome at a time when we need to be building 20 and 30-year clean energy infrastructure and therefore generating a lot of long-term debt. One form of regulation is working in the interests of an important and vital transition that another part says we need to do. We need to rethink our financial regulations to ensure we are not inadvertently working against the biggest challenges of our era. There are other ways of ensuring stability in the banks that need to be explored. The second area that we will need to act in is lift up for investments that simply do not have a long credit history at the scale we're talking about. And as a result, understandably by Standard & Poor's, Moody's, Fitch's and others, will be rated relatively risky and have a higher capital cost. Remember that this is a high capex set of infrastructure investments we have to make. The cost of capital is a really critical feature. In India, in a solar plant, 20-year lifetime cost of a solar plant in an environment where you have to borrow at 14% to 18% amounts to 2/3 the overall cost of that plant in interest. The interest payments add up to 2/3. It's extraordinary. If we can halve the interest rate in India down to 7% or thereabouts, we save a third the lifetime cost of a solar plant. That's what we need to do with high capital expenditure investments, work on the cost of capital. Risk bridging, guarantees, foreign exchange, hedging pools, subsidies, tax credits, regulations that shift capital from one area and mean it can't go to another area. These are all parts of the toolkit that we've used for 100 years to drive capital. They need to be used to provide support for priority transition investments. Finally, in terms of solutions, we need disclosure, discovery, definition. We need to be able to quickly find this pool of investments we need to make. Insurance funds and pension funds, let alone us as individual retail investors, do not necessarily have the due diligence capability to hunt around bonds to figure out those that are most pertinent to climate change. Some do, very few. We need to make it easier for us all to put our money to work to give us a good return and contribute to saving the planet, or at least saving our civilization. That's where labelling of green bonds, as well as other assets and projects and investments, becomes important. And that's what we've seen in this market today. The rapid growth of the green bond market has been a feature in the last couple of years of investment. We've seen a tripling in the last 2 years of bonds originally from the development finance institutions, and more recently in the corporate earmark sector, and then municipal bonds. These are bonds where the proceeds are allocated to green and climate investments. It doesn't mean complicated structures. It means vanilla bonds, standard bonds, with a simple interest rate, with transparency and reporting involved to give us confidence that the proceeds are being allocated to the kinds of investments that make a difference. Pricing is generally comparable to other bonds. That is, we are not seeing an extra cost to going green. This is at a 90% investment grade market, safe, secure. We currently expect the market this year to be up to $70 billion of issuance. It may be less. We've had a slow start to the year. Refinance as well as project finance is included. It's important to understand the role of bonds in the capital ecosystem. They are primarily a tool to refinance investments that have been made by equity, shares and small investors, and bank lending. You need some expertise to be able to invest in projects that's typically not there in the bond market. But once you've developed a project, 3 years into a solar farm, you can then refinance the bond market at a lower interest rate, lowering your lifetime cost of capital, and recycle that scarce pool of development equity into new projects. That's what we need to do. I'm going to hand over to Tess to give us some more on the slide.
Thanks, Sean. So if we look at the types of projects that are being financed by these green bonds, we took a look at all labelled green bonds that are outstanding and what they had declared at issuance that the proceeds were going to go towards. And the results are shown here on the pie chart. As you can see, the biggest portion are actually going to renewable energy. This isn't surprising given the fact that when typically you discuss with stakeholders what they consider as green, renewable energy is an easier concept to understand than maybe what sustainable water is or climate adaptation. So we're seeing issuances from the likes of Terraform, Tenancy, Iberdrola, EDF in energy, but increasingly as well in low carbon buildings in the buildings and industry section, from the likes of Development Bank of Japan, US municipals like Arizona State, Berlin Hip brought out a bond this year, and Stockland in Australia. So there's a real growth in that area as well. But the smaller sections on the pie chart are also growing, especially as the market develops. And it's we've seen some interesting developments out of the water and transport space, with the likes of Transport for London issuing a fully transport-focused green bond earlier this year.
Why do issuers do this if they haven't got a price benefit of note? They're doing it in the moment in this market for investor diversification, very important driver for treasuries who continue to issue bonds on a repeat basis. For stickiness, as quoted by KfW, the German development bank, for a deeper engagement with their investors, which gives them a stronger pool of investors for the next bond and the bond after, that lowers transaction costs and improves their ability to get a good interest rate. We're seeing longer tenors available for green bond issuers than normal market. This is a market dominated by insurers who like longer dated bonds, and it's a buy and hold market, as in people tend to hang on to the green bonds compared to other bonds. We're seeing solar developers come into this market getting some price benefit because it's a larger market than solar, and therefore there's less of an illiquidity premium. And we're seeing banks who may not have enough bonds in a solar area to issue a thematic bond, issuing a multi-asset bond, solar, energy efficiency, green property, wind energy in one lump, and getting scale through it. We expect to see price movement over time, but we will see the biggest price support eventually coming from governments with various kinds of measures to incentivize the market, as China is currently working to do. The majority of bonds in the market now reference some kind of independent review or separate standard. This is a big achievement of the past year in this market. Some 60% use an independent review of one form or another, which is a ESG or a company, or getting a climate bond certification for the bond using independent verifier. The EIB is using KPMG, the EIB being the European Investment Bank, to do an audit of their bonds, which is the red color in this particular pie chart. And then many bonds are using or referencing US Green Building Council LEED or other kinds of building standards as an indicator of the quality of their green property bonds. In the more recently, we've seen the growth of certification, and I'll talk more about that as a standards-based approach to scale up this market in the future. Examples of a continuing investor demand are the $1 billion green bond portfolio pledges of many organizations. Zurich has 2 of them. The investor statement available on our website of $2.8 trillion commitment to the green bond market. And Norwegian Sovereign Wealth Fund has a green bond mandate. Specialist funds are coming in. But most importantly of all has been continual oversubscription of green bonds. Now, this is admittedly currently a warm or hot bond market. So we have to put that into context. But we typically see slightly stronger demand for green than others. ABN AMRO got €1 billion of orders for its 350 million inaugural issue, green bonds, and they upsized to 500,000. And just this last week, China's Goldwing energy company issued a green bond in US dollars. They got $1.4 billion of orders for a $300 million bond. So it's not just a developed world phenomenon. More recently, we've seen Green Fund Brief in Germany, the rise of social bonds, where people are mixing a green with non-green assets, typically when they don't have enough green assets to create a big enough bond that's just green. And we've seen certified climate bonds from 3 large banks. We now have an ecosystem of green bond indices around the world. We have a voluntary industry set of guidelines called the Green Bond Principles that have been renovated this year, which are helping to educate the market. And Climate Bonds Initiative has launched some advisory services to support issuers considering coming to the market. But of course, there's much more than just a labeled green bond market. We have a broader universe of climate themed bonds, which is the main body covered in this report. We do have project bonds, solar and wind as well, which are not necessarily part of the green bond market, because they haven't done reporting or checking up front. Our goal, of course, is to make all of this market understood by investors as part of the pool that they can allocate capital to as a way of addressing their macro concerns around climate change. That's the objective for this year, so people can understand what really is green, invest accordingly, and allow us to have a thematic universe that's large and liquid. We're interested in liquidity for that refinance reason. The more large and liquid this market seems, the easier it'll be for equity investors and bank lenders who need to securitize loans to get them off the books, especially in Europe, to be able to refinance their investments into the bond market. Once we get above this $600 billion, we will then need government turbocharging of this market to be able to make the difference. We aim to see $1 trillion a year issuance in 2020. That's what we need to do to be making a material difference to the challenge of climate change. Tess, over to you.
So when we looked at how we approached this year's Bonds and Climate Change report, and we found the state of market $597.7 billion of outstanding issuance right now, we really took a look across all mitigation and adaptation sectors and identified the key areas of investment that are in line with our climate bonds taxonomy, which is available on our website. So these are including renewable energy, so we include nuclear in that, although we understand that it is controversial for some investors. We do consider it as a low carbon investment. Bioenergy, geothermal in water, sustainable water infrastructure, waste and pollution management, agriculture and forestry, low carbon transport, including electric vehicles and BRT systems. And we also include bonds that are financing more than one of these sectors. So we call it a multi-sector bond, but those are the development institutions or municipalities or banks that actually have different assets on their balance sheets that they're grouping together for bonds. These are actually all typically green bonds. So once we'd identified these different sectors, our methodology was to screen the entire bond universe and identify those issuers of bonds that have over 95% of revenues coming from climate-aligned assets, and then to pull back all the bonds that they've issued since 2005 that are still outstanding as of 10th of June 2015. So these bonds were added to our collection of labelled green bonds and to the project bonds to create the full $597.7 billion universe. If we take a look now at the next slide, which shows the breakdown of the universe, so we can see here that these are all the different sectors, but how does this compile the full universe? Well, as you can see, actually the largest section of the universe is low carbon transport. So this differs from what we saw earlier with the labelled green bond market, which has the largest part of energy, which is the second biggest if you look at the full universe, including climate aligned and project bonds. So transport is the largest part, mostly driven by the inclusion of rail bonds. These bonds from the likes of China Railway, Eurofema, SNCF, Network Rail. And so these are a large chunk of the transport universe, though there are other bonds in that transport, including electric vehicle manufacturers such as Tesla and push bike manufacturers such as Ideal Bike Corp and Sunrace. If we look at what's going on in the rest of the sections, we've actually seen a large growth this year in sustainable water, driven mostly by the rapid growth of the labelled green market. So municipalities issuing such as DC Water, Indiana, Chicago, from the States, and really to finance projects such as widening stormwater tunnels or energy efficiency projects in wastewater treatment. We've also seen buildings and industry is the third biggest theme, is a solid part of the fourth biggest theme is a solid part of the universe, and that's really in addition to the low carbon buildings that we talked about in the labelled green bond section. There are also LED manufacturers and other energy efficient manufacturers included in that section. The whole universe, if we look at it, has actually increased by 95 billion this year. All of the figures you see there are outstanding amounts. So we've had an increase this year, and actually almost a third of that was due to the growth of the labelled green bond market, with a further 40% of the growth this year from rail bonds. So if we have a look at what type of bonds these are in terms of their rating and tenor on the next slide, it's really a mixture of a real range of tenors and ratings. Sean, can you move on to our next slide, please?
No apologies.
Thank you. So if we look at the, as I said, if we look at the rating and tenor, there's a real mixture here. Though, having said that, the majority are actually investment grade. So we're not talking about a niche market here that only appeals to a certain type of investor. We're talking about a large liquid universe that can be accessed by mainstream investors looking for investment grade opportunities. Though there are sub-investment grade opportunities as well in, Metro Lisbon and Tebrek, to name a few, and some of the energy bonds such as Abengoa and Infinis are also sub-investment grade. But this is to show you that really there is a range of ratings and also tenors, although the tenors do have a skew towards longer dated tenors, and this is because of the length of climate projects and showing especially the longer dated rail bonds. Sean, I think that I'm still seeing the last slide, if you could click. I think we're having just a technical difficulty, so just bear with us please while we figure that out. So if we talk overall, what the opportunities for investors are in the entire universe of 597.7 billion, there is, sorry, I think I'm having a technical difficulty, so I'll just continue on. Sean, correct me if I'm going too quick here. The opportunities for investors in the overall universe, we've split this out into three different ways. We've already discussed what the opportunity in the labelled green market is earlier on by Sean. We've also got project bonds, which are bonds that are backed directly by the project, so the revenue streams are financing the coupon. We've seen a couple of interesting project bonds this year, including Hallett Hill from Australia, which issued two project bonds, both in the private placement market in the US, who were very successful. And interestingly, they had a second opinion from DNVGL, so copying the labelled green market, which is an interesting development, and that was backed by 34 wind turbines in Adelaide. Another interesting development in the project bond space is that S&P Dow Jones Indices has launched a green project bond index, making it easier for investors to locate these bonds and also building a pricing history of the bonds, which is important for the development of the market. Finally, we wanted to give mainstream investors an idea of what they could get involved, they could be accessing in terms of the climate-aligned universe. So we put onto the full universe some of the mainstream index filters. The reason we did this was that mainstream investors tend to use indexes to build around to create their mandates, whether it be in active management to seek to beat the mandate, the index, or whether it's to track the index directly. And these indices, the mainstream indices, tend to have a few key features, such as only investment grade bonds are eligible, they have to be a certain minimum size, such as $200 million, and also they only are accessible by if you're denominated in mainstream currencies. So once we put the filter onto our full universe, we found that there was still 266 billion of bonds outstanding across a range of the themes that we have, though it is notable that agriculture and forestry, which tends to have smaller bonds, there aren't any opportunities within that particular theme, though the rest of the themes are well represented. And and there is a real diversity in the credit ratings, even within investment grade there. For those investors that are interested in non-mainstream currencies, obviously there's a huge amount of Chinese bonds within the universe, which are not included here if they're denominated in Chinese yuan. So there are opportunities outside this universe, but this is to give a flavour that those mainstream investors can be accessing these climate-aligned bonds right now. Sean, I'll hand back over to you for the standard.
Okay. Thank you, Tess. Look, I'm sorry, we seem to have a problem with your screen, Tess. I need to check if anyone else can see the climate bond standard and definitions screen. Katie or Rosalia, can you confirm that my system is operating?
It is, yes.
Okay.
Yeah, I see that as well.
Great. Apologies that for everyone, the miscommunication at our end and my flipping around slides. I'm now going to just say a little bit more about the climate bond standard, then wrap up. The climate bonds certification scheme is a scheme to try and provide a low-cost means of being able to compare apples of apples when it comes to bonds globally. So this is a scheme to provide clear definitions to market about what are investments that can be used to back climate bonds, climate certified bonds. It's a scheme to provide clearly codified means around reporting and transparency measures and allocation of proceeds so that we can provide comfort to investors about how their bond is being used, their proceeds are being used to finance climate-related investments. The idea is relatively low cost, but nevertheless robust. It's very important in growing this market that we have full comparability, that we have simple standards if we want this to grow to $1 trillion market, and that the cost of transaction remains low. That's a vital issue to ensure participation of many players in the bond market. The tension is the issue between cost and the level of robustness. The way we're doing that is having as a public good clear criteria that have been developed by international expert committees. In some of these committees, we have 50 people involved globally, looking at what is the rule set we need to have in place to, if we're going to include rail, if we're going to include agricultural investments in the context of climate change adaptation, resilience pressures to avoid deforestation and so on, if we're going to include geothermal. Let me just give you an example of the work of the committee in the geothermal area. When we started, we thought this would be a simple inclusion criteria. But in fact, we found that in some areas, geothermal, which is drilled down through calcium, and water is pumped down as part of the geothermal, leads to a significant level of greenhouse gas release. And that means that a geothermal plant can have a very high greenhouse gas profile, beginning to look like a coal-fired power station when everyone thinks it's a clean energy project. Understanding the nuance in each of these sectors is important to having confidence about the low carbon and climate resilience credentials of the relevant investment. In the climate bond certification scheme, independent reviewers, EY, DNV and so on, we're in discussions with PwC and we're hoping to join. This is a little bit of a nudge to say join the party. Will become part of our audit family. They can do audits against the standard when there is a clear, independently produced set of criteria. The scheme is backed by a board representing $34 trillion of assets under management and other organisations. So it's very much a buy-side-led scheme. These are the criteria that are currently available. There are a selection of criteria about to be released over the next few months in areas like water utilities or rail or forestry investments, and more will come next year. It's a three-step certification process, very simple. Identify the assets, get independent verification, and track and report. The prescriptions for growing this market that we're providing for governments and the like. One is to grow this market, we do need in each market, like Brazil, like Indonesia, demonstration issuance, which allows us to engage investors and educate the market about how to do this from highly rated blue chip organisations like development banks and government bodies. That's how bond markets always get started. KfW came to market in Germany with this explicit objective. We need a pipeline of green projects. The truth is we have the demand. We have a wall of money looking for investments. We now need to deliver to those pension fund and insurance fund investors that are interested projects they can invest in. We need a pipeline of green infrastructure ramped up globally. That's what we need for climate. That's what we need to grow this market. We will need to tackle the challenge of aggregation, particularly in emerging markets, a lot of fragmented small investments. More on that as the year goes on. And then I mentioned earlier, the transition will require risk-bridging investments by the public sector. Let's make no mistake about this. This is an era where we need to change things quickly. We do not change things quickly, rapidly reindustrialize our economies and our societies without the activist support of the public sector, of our public sector, with risk bridging and so on. This is what happens in wars, where guarantees are provided to private companies to say, you must now start building tanks as required. That's the toolkit we have always used to build infrastructure in developed economies. Finally, financial regulation. Negative capital charges are currently being considered by the Chinese government, and we expect that as an example of the sorts of measures to be looked at in other countries to be taken up. This is where, on the balance sheet of a bank, there is a preference being given to green bonds over other bonds. They get a higher leverage ratio that allows them to be able to lend more to the green sector. Why? Green assets often have a higher performance rate when it comes to buildings, energy efficient homes. In other areas, it's because the policy priority importance of shifting to green. The Chinese economy, as you know, is a very dirty economy when it comes to its carbon footprint. This is being played out in the lives of people in Beijing and Shanghai and the air they breathe. The government understands there that they need to shift the economy into a different footing. So green finance, including green bonds, is now becoming a high priority as part of that rapid change. There'll be lessons there for all of us around the world. To finish up, next, we hope to see, we believe we will see, a change in the narrative of international climate change discussions. We need an international climate change treaty, but it's going to take time. Frankly, with the US Congress's difficulty, we are unlikely to get a substantial agreement this year, even though we'll make progress. But in the meantime, there is a shorter track for us to pursue, which is a green infrastructure revolution, a stimulus revolution. Economic multiplier impacts of infrastructure are well understood. Green infrastructure is no different. We need to be able to generate a close collaboration between the large institutional investors and governments about the transition to a green economy, essentially deal making, so that we can actually use the capital resources we have as a society in pension funds and insurance funds that are searching for yield and long-term investments to finance this transition with the support of government or with the active engagement of government. That will include shifting development banks to become more leverage institutions and direct lenders over the next few years. We will see new markets. China will take off like a rocket by the end of this year as a green bond market. We've been working with the Central Bank of China for the last year on developing proposals for green finance and green bonds, along with the UNEP inquiry into the design of a sustainable financial market. The central bank is now drafted green bond guidelines, which will come out over the summer or early autumn. Then we'll see a boom. India has beaten them to it. There have already been 3 green bonds out of India, and the government is encouraging development banks to issue green bonds as a way of adding liquidity in the market and engaging investors. Demonstration issuance. Mexico, Brazil, and other countries are coming along in the same way. We've seen the securitization market going in solar in the US. We expect to see it happening in India and Africa with some projects that will be announced for the climate change conference at the end of this year. And in the green city bond area, remember I mentioned 82% of emissions are as a result of city activity or from cities. We will see the growth of cities issuing green bonds or utilities to finance green infrastructure We're setting up peer exchanges between treasurers and things like that. And then finally, as I've mentioned, market integrity. Standards and certification, we believe, will be important to fuel a rapid growth of this market so that we can achieve what we think we need to achieve, we must achieve, if we are to make a substantial contribution to the transition to a low carbon and climate resilient economy. And that is $1 trillion a year of issuance in 2020. Please join us in making that future, that objective, a reality. That's the end of the formal presentation. Should you have any questions, please type them into the Q&A box as indicated. And we can see them. I'm going to just say to Katie and Rosalia, I can't see any questions coming up in case I've missed something with my technical klutzness. If you could let me know. I'm going to finish up and say that we have in front of us a particular privilege. That is that we have a sense of what might be happening in the future, a good chance of what is a difficult future. In other words, we're aware of the danger. With awareness of danger comes great responsibility. That's the responsibility to act and face that danger in every way we can. For those of us in the financial sector, working in banks, working in consultancies, working in investment houses, we have the privilege of an opportunity. That is the opportunity to act. We have to take that opportunity. Thank you for joining us today. If you have any questions, please do email us at info@climatebonds.net and we'll come back to you. We look forward to continuing to work with you in developing this market in the future.
Sean, we have one question come in.
Please.
Can you kindly share the highlight of Indian market? How do you see the market will grow?
We believe that in India, the government has decided this is a priority area of investment. They are opening up regulatory measures to allow green bond investment by overseas investors and supporting domestic investment. As a result, we think we will see a significant contribution to the very ambitious clean energy, clean water and low carbon transport goals of the current government. Now, how big will that be? I don't know. We are hoping that next year India will see $10 billion of issuance. So not a huge piece, but a substantial piece. The Indian corporate bond market is very small. The Reserve Bank has been trying to boost that and has done some very interesting things in the recent times to encourage blue chip demonstration issuance in that market. So we're hopeful of the growth of that sector, but it will take time, whereas the Chinese market is already the world's third largest bond market, and so growth will be much faster, we believe, in China. Having said that, we expect at least 3, possibly 5 green bonds to come out in India before the end of the year of a substantial size, and we're certainly working with the Indian government and various other industry sectors, such as the Federation of Indian Chambers of Commerce and Yes Bank, to actively grow the market. So it's a critically important market for the global challenge we face. It will certainly grow over time into a substantial market. We expect overseas investors to be the most important, not the exclusive, but the most important initial days. But we, over the next 2 to 3 years, would like to switch that to having domestic investors being dominant in. India certainly has adequate domestic pools of capital. They're just misallocated now into property, into gold, and in sectors like that. This is part of a broader strategy of reallocating capital within India. I hope that answers your question. The future is certainly bright for green bonds in India.
Sean, we've got a couple more questions. Can you see them on the Q&A, or is it easier if I read them out?
Could you read them out? For some reason, I can't see anything on the Q&A.
So, do you have any numbers on the part of refinancing versus financing new projects at the current state of the market?
In the labelled green bond market, we don't have detailed analysis, but I think it's roughly about 30% is allocated to refinance and 70% allocated to new projects, which is a reflection of the extent to which development finance institutions that are borrowing to invest in new projects dominate the market still, with some 40% of issuance, and they're all of that ilk. We expect that to change. In the broader climate bonds themed universe, we see a lot of bonds raised to refinance, and so the proportion is higher. I'm afraid I don't have an exact, I won't venture an exact figure without a solid base for you, apart from saying I believe it'll be close to a majority, if not a majority. Now, of course, it's important to differentiate between the credit base of a bond and what the proceeds are being allocated to. So the investment grade nature of this market is because the bonds are effectively being raised against balance sheets composed of existing mature assets. So from a credit perspective, a corporate bond where the funds are raised for new projects is still effectively a refinance bond in the sense of credit aspects because of refinance. So bear that in mind in this thinking about how we define refinance and new. Go ahead.
Do you think that independent verification will be used for green bond issuances also in China and India? And then the second question, could you share some corporate names in India who are in the process of issuing this year?
There have been some media articles in India about the government suggesting that state banks issue green bonds. I'm going to refer to those rather than repeat them. I can simply say that Yes Bank, I hopefully will come to the market again over the next year for a second green bond, if not sooner. And then you can expect organisations like iReader and other state banks in the party. Beyond that, I can't disclose. We do believe that independent verification will become established in India this year, but it is sometimes a Wild West market, so it's going to be a tougher process of selling it. The question is, can we avoid a scandal before we ensure that independent verification is standard, in a standard of green credentials? In China, the regulatory environment will direct people to definitions that are provided by the People's Bank of China for the interbank market in the first instance. Independent verification may not, we're not sure yet, be required for the major highly regulated banking sector, large banks. As we move into corporates and municipal, we expect certification to become the norm in in China, but that will take a little time to establish. Go ahead, Katie.
That's all the questions I've got for now, Sean.
Thank you, everyone, for joining us today. On that note, we will, at 8:59 in London time, close the session. Look forward to working with you to grow this market in the future.
Sorry, is there time for one more? We've got one more just in.
Dive it quickly, Katie.
In which area of the world should green city bonds grow most? Europe, USA, or China?
All three. But in 2018, our expectation is that China will be the largest of those three markets when it comes to green bonds. Thanks again, everyone, for joining us. On that note, finally, we will close the session. We look forward to talking to you in the future.